Right now, I'm showing an article that came out this just today, actually, from Jim Rickards, and it's quite a headline, as you can all see. First of all, before I get into this article, I want to give some background of where we are from my perspective, studied perspective, on the global economy, because the title of my presentation is Precious Metals in the Global Economy. First and foremost, beyond anything that I can tell you, is that financial markets are extremely difficult to navigate. Anyone that's tried to trade for a living or whatever realizes that markets are not a pure math formula. No matter what advantage you have based on trading platforms or price earnings or whatever, we can determine whether something is undervalued or overvalued. What we can't determine is what the psychology behind buying and selling actually is. As these algorithms and quants become more and more skilled at what they do mathematically, it's actually become easier to use classic methods to find value and determine if something's overvalued, undervalued, and expect the market to, at some point, reach what we call parity or fair value. Having said all that, the basic premise of everything I do starts with one basic idea, and that is that every time that anybody in all of recorded history has gone on an unbacked fiat system, it has always failed, 100% of the time. So in the financial markets being difficult to navigate, there's one sure thing, and that sure thing is that any time that we, as either a globe or nation state, has been under a purely fiat, unbacked monetary system, there's been a failure. In almost all cases that are recorded, you can make the exception of the Roman Empire, perhaps. What we have seen is that you could escape. If you go to the Weimar Republic in 1923, you could have gone to Austria, you could have gone to France, you could have escaped. Not that everybody had the opportunity to escape. The idea was that it was an isolated event that certainly affected a great deal of people. But you could have, if you weren't in that direct location or trading partner with that entity, such as the Weimar Republic, you had the opportunity to basically be free of it. However, that's not true in this case. This is the first time where we can truly say that the global monetary system is one, and it's based on the reserve currency of the world, which still remains the US dollar. So as the dollar goes, so goes everyone else. Now, I understand quite well that the currencies fluctuate, they all float, they're all backed by nothing more than rhetoric and political will and psychology. However, the federal government, the Federal Reserve rather, has given us a very accurate, from their metrics, valuation of the US dollar from 1913. And if you go to the website, what you'll determine quite easily is that the value of a 1913 dollar at 100 pennies in 1913 in today's equivalent is worth roughly 3.5 cents. So there's been a failure of about 97% of the dollar in roughly 100 years. And basically, we're at the end throes of that. Just a couple of quick examples. I was thinking this morning about my notes for this presentation, and one that occurred to me was that when I was moving from Southern California to Northern California, my dad was an electrical engineer, and we moved to Cupertino. And most of you may know that Cupertino is pretty close to the Silicon Valley. It's, I think, where Apple actually started, was Cupertino. And my dad bought a middle-class house, probably a little bit above that, but at least a middle-class house, on a flowing creek in a neighborhood, brand new, for $35,000. And today, $35,000 buys you a fairly decent SUV. So that's a kind of inflation that's been insidious that we all accept. But if you look at the metrics, if you look at the true picture, if you take the inflation lie out of the wage rate for the average US citizen, it's been a declining basis from roughly 1977. Again, I'm using the government's own numbers. And if you believe what I believe, the metrics that are used to calculate inflation have been greatly distorted since 1980, when using those metrics, we would have far higher unemployment and a far higher inflation rate. So that brings it to back to the point I want to pound again, and I'll say it one more time, is that all fiat systems have been destroyed in the past. Will it happen to the dollar? It's happening. How does it end up? No one really knows, but usually it does not end well. So now I'll move to this article that I have on the screen share. Jim Rickards has become one of the better known commentators in the gold space primarily. I'm known more for the silver side of things. And let me pause there for a moment for anyone that sees this on YouTube on the replay. As the publisher of the Morgan Report, we look at all assets in the mineral base. In other words, we're not just gold and silver only, although we spend a great deal of our time there, but we look at all the resources, which means the base metals, the energy metals like cobalt, lithium, vanadium. We were first to actually publish the rare earth elements that were such a big hoopla for some time. We also look at other energy metals like uranium. We were first on the zinc story before any banks were publishing there would be a shortage in the zinc supply. So coming back, I just want everyone to realize that the Morgan Report, if you're looking for how to invest in lithium or how to invest in cobalt or any of these other metals that are so critical to today's economy, that we cover them all. So back on gold and silver. Jim Rickards put out an update last night live, and this is basically a summary of what he said. And I'm not necessarily agreeing or disagreeing with it, but I will give you the 10,000 number, gold to 10,000 coming by January 1st, 2018. I will go on record as I highly doubt that we'll see it that soon, but that's the title. What I will say is that it's very easy to determine the paper price of gold. All you need to do is take the amount of gold that is purportedly held by the U.S. Treasury, divide it by M1, what the Fed will tell you is the money supply in hard currency and checking book money, and divide the two, and you'll come out with a ratio. I did that back in 2000, and the number was $2,500 per ounce. Since 2000 to 2017, that number has increased by a factor of roughly 4. And it's a very simple arithmetic problem. You take the amount of M1, divide it by the amount of gold, you come out with roughly $10,000 an ounce. So that's where the number comes from. It isn't magic, it is verifiable. And what I pointed out, and I wrote an article about this called Engineering the Price of Gold. When I did the math, I came out with the $2,500, as I just mentioned. I also went back into history and I said, well, what happened in 1980? If you did that same basic arithmetic problem in 1980, the price of gold based on M1 and gold would have come out $400 the ounce. However, gold peaked at 850 spot, 875 in the near month, January 21st, 1980, which suggests that like all markets, they go from undervalued to fair value to overvalued. Gold was actually overvalued by a factor of 2 on the day that it peaked, January 21st, 1980, which suggests that this number of 10,000 that I'm speaking about currently may be on the low side if there is what we call a panic move into the precious metals. So I want everyone to be aware of that. Again, no one knows the future. Is it going to go to 10,000? Is it not? That remains to be determined. He also goes on to say that the currency reboot will see leading nations devalue their currencies against gold. We all know, or most of us know, that gold has been moving from west to east for quite some time. This is very much a historical move as well. If you go back in history and study monetary history, you'll find that whoever is the greatest producer of actual physical commodities and finished goods is the leader holding gold. And this was true of the United Kingdom, the British Empire, if you will. At the time, they were, without a doubt, the greatest exporter of finished goods and were basically, the sun never sets on the British Empire. So they were basically the leader on an economic, physical basis of the world. Well, that changed, and over time it became the United States. And this is when the United States started to actually obtain a great deal of the gold supply. And that's been true up until the last few decades, where gold has moved primarily from west to east, moving into China. And China now has become basically the productive capacity producing most of the finished goods that come through the world. And this is very much on par with what we see throughout history. So gold moving into China as a basis of money, which basically no one really talks about or admits, but the facts are the facts. Gold's been moving into China hand over fist for a very long time. It's also gone to Russia. It's also gone into India. So we're seeing the world's productive capacity move into the cheap labor, which is those areas with the goods coming from there, and the movement of gold into those regions. So that's another factor that basically supports my thesis that this is not unusual. It's very much part of the age of empire. As one empire is declining, another may come to the fore. But that doesn't negate my basic premise that we are in a situation that everyone's tied to the dollar. Now, the Chinese and the Russians, the BRICS primarily, Brazil, Russia, India, China, and South Africa, band together and basically tried to escape the dollar by moving into their own consortium to basically remove themselves from the SWIFT system on monetary settlements. And this may help the problem in some way, but I really doubt at the end of the day it's really going to do much good. It's possible that it may help them slightly, but again, I doubt it will really have much effect, although that's the purpose of it. Moving on, debt is the problem globally. We're basically in a situation on a global basis where no one can basically pay back their debt. The United States debt is now at 80 trillion, according to Richter's article. 20 trillion, as we all know, is a national debt, and there's 60 trillion in consumer debt. He sees a monetary reboot or currency devaluation coming ahead, and this is true. This is usually what happens. These currencies that we talked about in the book, The Silver Manifesto, there's been several since just 1990 that have failed, but most people are unaware of it because, again, the dollar is the currency that's used as a default currency no matter what country you're in on the planet. You can resolve your problem by using US dollars, and this has happened again and again and again. It's when the dollar fails is when there's going to be a very big problem. So right now we're at a point where this will probably accelerate. And just to put in my thoughts on the subject, I don't see a reset coming by January 1st, 2018. I wasn't on the call last night with Jim, so I'm not sure exactly what he said. What I think is we are looking at the biggest move in the precious metals over the next 3 years or so. All markets move up in three basic legs. I'm not a huge Elliott wave person, but I do believe that there are three legs up and two down. We've had one leg up in the precious metals, a large correction, a second leg up, and a very large correction has been about 5 or 6 years. And the next move up will probably be the longest move up and probably the shortest amount of time. I'm known for saying that 90% of the move comes in the last 10% of the time. And that is a very accurate analysis of what took place in the 1980 bull market. If you look at the 1980 bull market, what you'll find is that you could make an argument that the market started in 1970 and ended in 1980. I prefer to say the market started at basically 1965 when silver coinage was removed from the US coinage. And at that point, silver started to float as far as what it was worth in paper money. And it went from the $1.29 monetary basis of 1964 to $50 again in early January 1980. But looking at the history of that move, what we find is that from the time that silver was demonetized totally in 1965, it went to early 1979 and it achieved a price of roughly $6. So from $1.29 to $6 over that 14 years or so was a decent move, and inflation adjusted, you had made real money. However, if you're a rank speculator or only bought things on a new high and you bought at $6 in January of 1979 and were smart enough to get out the top in January of 1980, you would have made over 800%. And that was in basically 1 year's time. So I actually did the arithmetic on it, and I forget the exact numbers, but it was actually more than 90%. I think it was 92% of the move, and it came in like a little less than 10% of the time. I think it was 8% of the time. So these are just rules of thumb. They're not exact, but what I'm trying to emphasize for everybody is that you are not too late to be into precious metals. Let me pause there. I'm making a strong case for owning physical gold and silver. But I don't want to make too strong a case because, one, again, no one knows the future exactly. And secondly, they can be dead assets, which means that the correct amount of gold and silver for a portfolio, anyone that's a portfolio manager or an investor of fairly good means, as you can see, this asset table that Jim has here suggests roughly a 10% allocation to gold and silver. And this is proven to be a good enough amount. In other words, you certainly want 85–90% of your money working for you in other asset classes and the protection of gold and silver against a currency crisis, which I definitely believe we are in. It's occurring now, and it will continue to accelerate. All right, so I'll continue. So coming back into what is the correct amount of gold and silver to be held by an investor, and the answer, it's indeterminable, but roughly 10% rule of thumb. I would defer to Ibbotson and Associates that did a portfolio analysis, and what they determined objectively is that the correct amount of physical metal, this is not mining shares or ETFs, was 15%. So they determined that under all economic conditions, inflation, deflation, stagflation, regardless of what the economic conditions were, you got a better performing portfolio if and only if you had an allocation to precious metals of 15%. And by the way, just to be complete in this, that included platinum. So it's gold, silver, and platinum when they did the study. So right now, hopefully the screen is back up where it's supposed to be. And this is a lecture that I did in London recently. And I just want to emphasize that there are other parts of my thinking besides the monetary system. This is the first thing that I put up, which is what runs the world. And people think, of course, that the world runs on finance, money, investment, and that sort of thing. And yet the actual fact is that the world runs on energy. And without energy, nothing happens. And for the most part, energy means oil. And I asked myself the question, are gold and silver the final solution? And I probably could say here without the slide that really, we're an energy-based economy where certainly money becomes very, very important the way the world is structured right now, but it's really energy that makes things happen. So betting and investing depends, and then I talk about a derivative because there's so many, and derivatives is part of the biggest problem in the financial system because not only do we have these large debts, but we have bets on top of bets, which are bets on the debt, primarily in the interest rate realm, which has everything to do with the debt markets. So a derivative is betting or investing, depending on what you want to look at, the value of the change in an asset. It can be a bond, a share, commodity, foreign currency. And two parties take out a contract, will exchange money based on the change of the value in that asset. It either moves up or down. One of them wins, one of them loses. It's simple as that, which means it's a zero-sum game. It's not like an equity where if you buy a good company that builds something that's wanted by the market and it continues to grow, such as, let's say, buying a good cellular phone company back 25 years ago, that company builds out and grows and grows and grows and grows. So as an equity investor, if you're an early one, you've done extremely well. If you did it 10 years ago, you're still doing well, that type of thing. That's equity. In these derivatives bets in the futures markets and the options markets, there's zero-sum games. For every winner, there's a loser. For every sum, somebody wins, somebody loses. And the derivative size has reached 370 trillion in 2007. Today, we estimate a quadrillion in derivatives. So again, I want to emphasize that these cannot be paid back. There's a winner and a loser. And the problem that happened in the 2008 financial crisis was the fact that these debts that took place instantly when the system started to fail was that the buyback was impossible. In other words, the counterparty risk was such that the winner could not be paid by the loser. And AIG, which basically insured most of the derivatives, American Insurance Group, one of the largest insurers in the planet, was failing. And this was one of the parts of the bailout, was to make sure that the counterparties were paid. And then, of course, there's a lot more to it than that, because at the time, the market was starting to freeze up. Bank A did not believe or trust Bank B's paper. In other words, all of these derivatives and many other financial contracts were basically laid bare, with trust leaving the system almost instantly. So the Fed did basically the only thing they could do, and they rushed in and they said, and I'm using Bank A and B to make it very simple and understandable, but this took place throughout the system. And the Fed came in and said, okay, Bank A, you don't trust Bank B's paper. Bank B, you don't trust Bank A's paper, but you trust Treasury bills. So we will take Bank A's paper, we'll take Bank B's paper, and we'll issue Treasury bills against them. So this is why the Fed came in and bought so much of these subprime mortgages, because that was primarily the problem, plus the credit default swaps and all the derivatives that surrounded these financial instruments. And they made them all whole by exchanging them for something that were basically worthless, that nobody trusted, and the system was starting to freeze up, into something that everyone trusts, which is financial instruments issued by the US government, which everyone trusts. And the system basically stopped from falling off the cliff, and everything went onward from there. And we've been doing that now for about 9 years. The problem is that governments fail. Now, there'll be an argument against that, but if you look at the Roman Empire, you can see it failed. You look at the Weimar Republic, you see it failed. So governments can fail, or let's say the banking entities behind governments can fail. Doesn't mean that they will, but they can. So moving back to the slide, the derivatives markets is a tool to hedge risk, but does it really? And I just gave an example of why it didn't work in 2008. And if we get into this similar situation, which we're now in, we certainly could be at a point where we really want to rethink what our portfolios look like, because there is the possibility. And again, I'm advocating a hedge position. I may sound doomy gloomy. I am a realist. I study monetary history, among many other things. And this is just to point out the fact that this is the reality that we're living in. And once you understand it, it is up to you to take action or not. I highly recommend, of course, that you do after you consider these points. So several studies on derivatives markets have been done for international, by the Bank of International Settlements, Bank of England, and on. I'll read it all to you. The GAO reports and recommends additional regulation for both derivatives dealers and end users of derivatives. The study concludes that over-the-counter derivatives could pose a systemic threat to financial markets if a major over-the-counter dealer were to default on its counterparty obligations, which again is what we've already seen in the previous situation. Now, changes have been made somewhat since the 2008 crisis, and the banks have been re-liquefied heavily by the banking powers, primarily the Federal Reserve of the United States, and they're sitting on pretty massive amounts of liquidity, and very little of that money has gone into Main Street. Most of it's sitting either in back to the Fed to earn interest on their money, and much of it has gone in the stock market. And I'm a big proponent that I feel the stock market at the current time is very overvalued. See if I can get this slide to change. So this is a liquidity pyramid, and this is done by my friend Trace Meyer on the Run the Gold website. But primarily it was initiated by John Exter. And John was a Federal Reserve banker from the New York Bank, and he invented what's called the Upside-Down Pyramid, which is a liquidity idea. And what it shows is, first of all, let me just state what I always do, and that is a pyramid is the most stable structure you can build. So that implies that an upside-down pyramid is one of the least stable structures that you can build. And if you go back and see the original pyramid, which I don't think I put in here, no, it's a lot more simple than this one. But since John did that probably in 1960 or so, things have changed a great deal because there weren't nearly the amount of derivatives that there are now. So going from the top, or the base, but we're upside down to the bottom, what we find are the greatest amount of financial instruments, and that again is the derivatives markets. And Trace has this at about 1,600 trillion. And these are the least liquid, hardest to liquidate in a panic, and very unstable. And then if you go down to the next level, these being the least liquid, the blue, and into the red, these are somewhat more liquid, and these would be private business deals, commercial real estate, residential real estate, and non-monetary commodities. Now, you could argue that these are more stable, but think about it. Most of your commercial and private real estate, and even a private business, these are contracts that are usually mortgages. And in a market that's moving quickly, you usually need financing in order to participate, especially on the commercial level. So these things are not that liquid. I think anyone that's ever bought a home knows that, let alone a piece of commercial property. It's sometimes months to settle a deal through escrow. So obviously, I think I'm making the point that this is not a very liquid asset. I'm not saying that commercial real estate or residential real estate isn't a physical asset. What I'm saying is, in a credit contraction, how liquid is it? Next, you come down into this yellow or gold area here, securitized debts and stocks. You've got your corporate municipal bonds. You've got your entire stock markets globally, and your U.S. listed stocks, which is an interesting number. At the time that Trace did this chart, we were roughly looking at 100 trillion. And compare that number to the derivatives market, which is basically 16 times larger. Now, we all know, stocks and bonds are fairly liquid in a decent market. It's only when there's, panic or whatever, where those would not be that liquid. And then what he calls broad currency illusions. And this is where I started my premise of all unbacked currencies eventually fail, regardless of the issuer. It's a basic trust or confidence game. And the broad currency illusions, of course, primarily revolve around all government debt globally, but here primarily we're looking at the U.S. debt because it's the most trusted still on the planet, regardless of what the BRICS are doing or trying to do. So you've got SDRs, you've got treasury bills, government bonds, U.S. debt, treasury bills, etc. And those are fairly liquid, as we all know. And then you come down, and we're looking at power currency illusions, and he's talking about physical notes here. He's talking about pieces of paper, or pieces of cotton, if you want to be explicit. They're looking at Federal Reserve notes, a yen note, a euro note, an Australian dollar, a Canadian dollar, etc. So these are actually what the physical pieces of paper money supply is on a global basis, taking in all the popular currencies, and that's roughly 4 trillion. And then at the bottom here, and again, this goes back to John Exter, you go to what he labels power money, which is gold and silver. You're looking at 150,000 tons, roughly 2 to 4 trillion. And that, in a liquidity squeeze, is the most liquid asset. I don't know the age of most of the people on this lecture, but I'm going to hazard a guess that I'm probably older than most of you. Again, I've been studying money and markets for 40 years. And there was a movie in 1980 called Rollover. And in that movie, it was a hypothetical where the Arabs decided to pull all of their investments out of every U.S. bank. And at the end of the movie, there's a big panic. The floor trader for a New York bank says they want everything sold. And for currencies, no positions. In other words, you wouldn't want to take a position in any currency. Gold, grab what you could get and pray. And this was a very good illustration of what would happen in a panic mode. Now, I'm not predicting this. I want everyone to know that. What I'm doing it as I'm using it as a metaphor for what a panic in an extreme case would look like. And you would see this pyramid in action. In other words, the most or least liquid trying to be sold for anything you can get, down to the money that's trusted for centuries, regardless of where it resides. Money, gold rather, and silver to some degree, can be used anywhere in the world at any time without question. And that's the only money that's been able to do that for thousands of years. Look at any currency throughout history, they never last more than really 40, 50 years, or they're changed. They can be, the Federal Reserve note's been around for quite some time, but look at the notes that have changed just in my lifetime. The pictures of the presidents have changed, have gotten larger and that type of thing. Anyway, back on point. So you've got a very small amount of gold versus everything else that's considered to be some type of credit-based illusion, or let's call it a reality, but very illiquid. So this shows you the problem. And again, in a liquidity squeeze, you would move down the pyramid. And again, I just want to emphasize that I'm advocating, 10, 15% allocation here. So it's not like, no matter how strong the case is, it's not a go in all the way and wait for the end of the world. That's not the way the world works. But we're in precarious times. And if you don't take action appropriately, you may live to wish you had. But again, that remains to be determined. Gold has certainly done well for those that got in the early 2000s, but it's really done nothing for the last 5 years, and I fully admit that. So gold is the universal prize in all countries, all cultures, and in all ages. This comes from the ascent of man. The BRICS, as I mentioned earlier, certainly getting together. They have put together the Asian Infrastructure Investment Bank, and they're basically trying to, let's say, move aside from the dominated Anglo-American empire, the US dollar-based system. This is a slide that I put in for some of my friends in London. Some of the Indians are rather very happy to take gold rather than Federal Reserve notes for their efforts. So let's talk about price and price expectations. This is from John Williams, and excuse me, it's not. This is a adjusted consumer price index chart for silver based upon the metrics of John Williams, which is the true inflation rate based on the 1980 metrics. And what it would show is that for 2007 silver price, you'd have roughly $250 silver. The cumulative world silver value is extremely small. If you looked at that upside down pyramid and you colored just the very, very tip of it in silver, you would have a good illustration of how small the silver market is. And I'll pause there. I want to make an emphasis. I had the idea of doing a silver summit many years ago. We started these in Coeur d'Alene, Idaho, very near the Silver Valley, actually. And we have people from all over the world that would come and attend the Silver Summit. And they still do, but we've moved it to San Francisco, California. And last year at the Silver Summit, Jeff Christian from CPM Group out of New York did a lecture, and he talked about the scarcity of precious metal, or maybe better said, how precious metals relate to the entire financial system. And he made the point that all financial assets, ex real estate, so if you go back to the pyramid and you eliminate the red block that was all commercial real estate, residential real estate, mortgage-backed securities, that type of thing, you eliminated that, and you just went into the derivatives markets, stocks and bonds, currencies, that gold represents 1% of the entire financial system. But this is what shocked me. Silver represented 0.02% of the entire financial system. So it gives you an idea of how small the silver market really is. This is a chart I love to show. This is one that was produced in Forbes magazine right after Warren Buffett disclosed that he had bought 129.7 million ounces of physical silver. And this again is an inflation adjusted chart. So this takes the inflation lie out of the numbers so that we can get a good appreciation, excuse me, for how the world valued silver in centuries past. If you come over here to the left-hand side of the curve, it starts at the year 1344, and the silver price in constant dollars is roughly 400. And then if you come into 1484, the actually all-time high is $1,477. And from that point, it declined and came down into this area here. I'm showing you can see my cursor perhaps, down to this level to about to basically 1800. And for all that time, from the 13th century all the way to 1800s, excuse me, we had $100 silver or better. And then from that point, 1804-ish and 1800 or so, we're roughly at the $100 level. And then it dropped down in the 1900s, all the way down into like the $20 an ounce level, shot back up in the 1980 move to roughly, on an inflation adjusted basis, about 70. Remember, this chart came out in about 1999, so that's like 18 years ago. And then all the way back down. So when I started the website in 1999, I was stating that silver was the lowest inflation adjusted price it ever been in recorded history. And that's true. People talked about silver being 22 cents in 1930 in the Great Depression, or actually later than that, 34 or 5. But regardless, on an inflation adjusted level, $5, sub $5 silver in the late 1990s was actually a lower price. And this is when Warren Buffett bought 20% of the world's above ground silver supply. And it shows it here if you can read it. I know this chart isn't focused really well, but it says Warren Buffett buys, and it's got a little arrow here and it's pointing down to basically the low. And these were billionaires. Very interesting. The billionaires were interested in silver at the bottom. Warren Buffett, Bill Gates bought a great deal of Pan American silver. And George Soros was one of the principals of Apex Silver, which really was not a silver mine, but it was purported to be one. It did have silver credits. It was basically a zinc situation. So this is something that I like to lecture on. This is something that is important to know about the speculative side of what I do in the mining sector. Basically, these speculative investments, if they get a discovery, will just rocket up exponentially and get very overvalued. And then if the project fails, you can see this red line just comes back down almost as fast as it went up. If it is viable, it will still come down over time, and it will take a great deal of time to build up. So this is something to be very aware of. I do not spend a great deal of time in the exploration companies. We do models of companies that basically produce assets. So these are producers, and it's very easy to get the metrics on them. And that's where we divide the portfolio from top tier, mid tier, and we do some speculations, but we're very careful. We put a little money to win a lot when we do the speculative side of the portfolio that we have, and explain everything that we do, of course. But the top tier categories, for example, one of the top tiers is a royalty company, which is the best way to make money in the sector on the gold and silver side, is up 600% even today. And we have a few more that are in the 300 or 400% category, and that's basically in a bear market. The mid tier that we have are producers that have the ability to discover more assets and or increase their production profile. And a lot of them have assets that can buy out others and increase their resources in that manner. This is another chart of the same idea, that you get a discovery, it rockets up, and then there's this big lull while the mine is built. So what you really want to do if you're in the discovery phase is you want to sell somewhere on the way up. I've done commodities trading for years. I like to sell into strength. I like to sell into this area, leave some for the next investor. I don't need to get the tippy top. I'm not an amateur, I'm a pro. So, and then you just move aside. And then you can, after everything is done, if it's still undervalued at this point, you can certainly buy it there and move up. In fact, we've done that in a couple of instances. This is sort of what we did after I called the top in the silver market. Some people got out fully, some held on, some hedged. I made a mistake of thinking it would only last 2 or 3 years. It's been 5 or 6, I admit that. But these are some of the moves that after we got back in, excuse me, you could see the kind of moves that you make. Lexo, 43 cents to 10.25. Endeavor, I think it's at $4 right now, but it hit 71 cents, as high as 13. These are highs over the time I did this lecture, which was probably a few years ago. First Majestic, we had that stock at 4. It's only, I bought it recently at 6 for a trade. I think it's at 7 right now. I'm writing some covered calls on it. Went to 20. It's been as high as 26. Silver Standard isn't on here. Silver Standard we bought at 65 cents. It went to $40. Gold Corp was one of our best performers. Silver Wheaton. So you can get the idea of what we do and the kind of gains you can make. Now this is one of the most volatile areas there is. The betas are extremely high, and again, this is only for like 10-15% of your portfolio. In this modality, it's really important to be able to hold some core positions and trade the rest. I'm not a big advocate of buy and hold. There are royalty companies that you can buy and hold for the long term and do well with, and if things get overvalued, you can write covered calls on them. I think that's a great strategy. That's one that I employ myself. So I'm going to go ahead and leave it off. I might have to take a question or two, Renee, but the core consideration, the rush to gold is primarily by nation states, but the rush into silver is basically by the people, not just the people of the U.S., but people of the world. There will be a rush into gold and then into silver like you've never seen before. Unlike 1979, this will be a global phenomenon. You will either have it or you won't. And that's something that I said way back, probably about early 2000s. When the rush to gold takes place by nation states to protect the monetary system. And it's an if, really, but I think it will happen. And you can agree or disagree. A lot of people will be left out of the gold market because they can't afford it. And I don't know where that exact point is, but for talking purposes, let's call it $2,500 gold. It'll vary person to person. But if the panic develops, people go to the next best thing, which is silver. And remember what I said a moment ago, that the entire financial system, gold represents about 1% of the entire system, and silver is only 0.02%. So think if it doubled in demand and it went to 0.04%, what that would do to the paper price of silver. Or conversely, what it would do to the paper price of gold. Jim Rickards, much better known than yours truly, has already said, you know, $10,000 gold. He's got a book, $10,000 gold. In fact, I handed it out at one of my lectures about a year ago after it first came out. And so we have a lot of upside in these markets. The best leverage or risk to reward profile is to the mining shares, but you need to be very careful on how you select them. And you need to make a portfolio that makes sense, which in our view, in 40 years of experience, is top tier, mid tier, and some speculation.